Please join me in welcoming Doron.
Thank you, Peter, for inviting me to this conference. My presentation, I'm going to review findings from academic research relevant for the prediction of future earnings. The outline of my presentation, I'm going to start discussing earnings measures that have been examined in the literature, and then move on to the analysis, time series analysis, and the various analyses which provide information relevant for the prediction of future earnings. The earnings measures that have been examined in the literature includes residual income, earnings per share, net income, NOPAT, and revenue. Most of the research focused on earnings per share and net income. Recently, there's more focus on residual income. Residual income compared to the other measures have several advantages. Of all these measures, residual income is the only earnings measure that you can directly relate to value. So if you have, and Shashun touched on this yesterday, if you have a series of forecasts for residual earnings, you can basically produce valuation. With other measures, you need to predict additional inputs, additional variables in order to produce a valuation. With earnings per share, you need to predict future dividend payout. With net income, you need to predict dividend payout and share transactions. With NOPAT, you need to predict investment in net operating assets in the future. And you also need to come up with a measure of the value of debt. Revenue, you need to predict expenses, investment in net operating assets, and again, to come up with a measure of the value of debt. So residual income has this advantage compared to the other measures. Residual income also is not affected by investing and financing activities that are not necessarily relevant for value. So earnings per share is affected with dividend decisions, which generally should not affect value, a point which was made yesterday and is well recognized in the literature. So you can think about residual income as being a preferred measure of earnings that people should forecast, but we know this is not the case. And there are several reasons for this. One of them is that for residual income, unlike the other measures, we cannot observe residual income. We need to estimate residual income because we need to come up with a measure of the cost of capital, to calculate the benchmark return on equity, something which does not apply to the other measures. We also know that residual income in the short term is not necessarily a good indication for what it will be in the future, So if you predict residual income for the next few years, we cannot predict residual income forever. The indication for value that you get from the predictions for the short term are not necessarily well correlated with a long-term residual income. So this is another important disadvantage. And probably for these two reasons, as well as other reasons, much of the literature is focused on earnings per share and net income. Again, recently we do talk about, in accounting, about the need to value the operation separately from financing. So we have more focus recently on NOPAT measures and other operating income measures. But this is pretty much the earnings measures that have been investigated in the literature. The early literature started with a time series analysis of earnings per share, and there was quite a lot of research in the late 60s, 70s, basically concluding that this model, random walk with drift, is almost as good as you can get when you predict annual earnings using time series information. So we're restricting the information set to include only past earnings per share, and we're trying to predict future earnings per share, and this model seemed to perform as good as it gets. There was, from the beginning, some evidence that when you have large changes in earnings per share do tend to revert to some extent. But generally, changes in earnings per share are persistent. So you can basically take the level of EPS that we have now, possibly add a drift, which is usually estimated using recent changes in earnings per share, and you come up with a forecast, which, again, almost as good as it gets. Now, much of this research was done 20, 30, 40 years ago, when large changes in EPS were not that common. But we know that in recent years, we see large changes in EPS much more than we did in the past because of fair value accounting, because of other reasons. So maybe if we reevaluate these models, maybe we'll find now that even with just examination of time series, we can get better predictions, not using a random walk model, but otherwise. But it seems that there's not that much interest in this type of research anymore. For quarterly earnings per share, the model that researchers came up with is somewhat more complicated. It has 3 elements. So basically, the benchmark for earnings per share is earnings per share in the same quarter the previous year. But then there are 2 things that we have to adjust for. First, we know that there is a positive autocorrelation in seasonal differences. So the second term that we have here, the C2 term, accounts for it. C2 is positive between 0 and 1. We know the correlation is strongest for quarters when the leg is small, but it continues up to 3 legs. And we also know that there is actually negative correlation for seasonal differences in 4 legs. So the same quarter the previous year, shocks that we have the same quarter the previous year are going to revert to some extent. So this model seems to be the most sophisticated time series model that people use for quarterly EPS. The problem with this model is that we know quite a lot from accounting about what we should expect. And these insights, there's very little research that incorporates these insights into the time series, into the prediction of quarterly earnings per share. Richard had some work, Andy Schmidt had some work, and there are some other papers, but generally you can say that this is largely ignored in the literature. The fact that for quarterly reports we use the integral approach, not a discrete period, but we rather look at each quarter as part of the fiscal year. So there is a lot of smoothing that takes place in quarterly reporting within the fiscal year. For example, with respect to inventory, the lower of cost or market, for quarterly reports we only apply this rule if we don't expect the market value to go up. LIFO liquidation. In quarterly reports we don't recognize LIFO liquidation if we expect that the LIFO liquidation is going to reverse. The income tax expense is measured based on the anticipated effective tax rate for the whole year. There are some costs that we treat as period cost for annual reporting, but for quarterly reporting we spread them over the year based on some measures of operating activity, usually based on revenue. So repairs and maintenance, executive bonuses, and other items, we basically smooth them over the year. So this use of the integral approach for quarterly reporting implies that for quarters that belong to the same fiscal year, we should have a much stronger autocorrelation than we do for quarters that don't belong to the same year. This is an important insight which generally has not been incorporated into time series models of earnings per share, quarterly earnings per share. There are also 2 additional points regarding accounting implications for the prediction of quarterly earnings per share. The first one, correction of estimation error, because we need to predict activities for the whole year, we'll have measurement error that will be revealed in the later quarters of the year, in the 3rd and 4th fiscal quarter. So in the 3rd and 4th fiscal quarter, annually the EPS will include correction for errors that we made in the previous quarters when we smoothed the expenses. Also, for quarterly reports, we can use estimates. So, for example, we don't have to take a physical count of inventory, but instead we can use the gross margin method for estimating inventory. Again, there will be estimation errors, and these estimations errors are going to be revealed in the 4th quarter, in the 3rd and 4th quarter. So in the 3rd and 4th quarters, we have earnings which are more noisy because of this correction of estimation error from prior quarters. We also know there is some research showing that special items and one-time items are usually recognized in the 4th quarter, sometimes in the 3rd quarter, but mostly in the 4th quarter. So 3rd and 4th quarters earnings are more noisy. Again, an important insight from research which did not seem to affect the way that people predict earnings using time series model in other contexts. Okay, so the early literature focused on time series models. But then in 1982, in my opinion, one of the most important papers in accounting, Freeman, Olson, and Pellman showed that if you consider, in addition to the time series of earnings, if you consider just one additional number from the financial statements, the book value of equity, and you calculate, using the book value of equity, you calculate a measure of profitability, return on equity, just this measure, return on equity in the current year, tells you quite a lot about where earnings are going from here. Specifically, when companies that have a relatively high return on equity today, for them, the earnings change is likely to be negative. And when ROE is low, the earnings change is likely to be positive. And this is due to the fact that return on equity tend to revert to the mean. When we have high ROE, what we're going to have next is probably a lower ROE. And when we have low ROE, we're probably going to have a higher ROE going forward. So this is basically the US, 40 years of data, non-financial New York Stock Exchange, American exchange firms, and this is what we see. So basically, we see these strong mean reversions. Mean reversion when we are at the extreme, when ROE is very high or very low. When ROE is very high or when it is very low, we do see that it tends to move toward the mean. But even within 5 years, we don't get a full mean reversion. We also see another feature of this is that this convergence or movement in ROE are not linear. We have a nonlinear shape where when ROE is extreme, it tends to move toward the mean faster when it is not that extreme. And we also see that there is more mean reversion taking place from the below the mean than from above the mean. So this is basically the result mean reversion in ROE. And why this mean reversion implies that we can use this to predict earnings changes, the mathematical manipulation is here. So if we are standing now at time 0 in period 0, and we are interested in predicting earnings per share in next year, period 1, we can show with a slight manipulation of this relationship, basically the definition of ROE, we can show that the change in ROE that we're going to have next year is related to the change in EPS, the change in EPS is related to the change in ROE. So if ROE is mean reverting, it means that high ROE implies a negative change, or low ROE implies a positive change. This is basically mean reversion. So you can see how you can incorporate the information. If ROE is high, this term is likely to be negative. If ROE is low, this term is likely to be positive. So this term is responsible for the mean reversion in EPS, the mean reversion in EPS due to mean reversion in ROE. But you can also see in this manipulation that there is another term. And this other term is related to the level of profitability next year and to the change in the book value per share. Now, we saw in the previous slide that even though that there is mean reversion, it's not a full mean reversion within a year. If ROE is very high today, it's also likely to be high next year, just not as high as it is today. So high ROE implies that this term is actually going to be high, relatively high. So this is basically, this term represents an offsetting effect in terms of the effect on EPS changes that ROE has. So yes, high ROE implies that this term is going to be negative, but it also implies that this term is going to be larger than for other firms. But this offsetting effect is also related to the change in the book value. And this is affected by dividends. So if you're going to pay dividends, this is going to be small. If you pay all your earnings as dividend, this is 0, and we basically have no offsetting effect. If you retain earnings, this will be positive, and we have this offsetting effect. What you can get here is some insight already regarding the effect of growth, which is due, growth in EPS, which is due to reinvestment of earnings, a point that we will get to later on. Why do we have this mean reversion in ROE? We actually have quite a lot of research on this, but the research usually are outside of accounting, and it talks about economic reasons, competition and entry and exit of firms, which will tend to drive economic profitability toward the mean. This is nice and relevant, but there are many other reasons which are primarily accounting driven, and they are here. We know that when we have high levels of ROE, it's more likely that we have a relatively large transitory shock this year, either an economic shock or simply a result of fair value adjustment, which are increasingly relevant. Another point which is not very well appreciated is the fact that when profitability is abnormal, either abnormally high or abnormally low, going forward, the new projects that we will have are not likely to generate the same level of abnormal profitability. Going forward, the profitability level of new investment is going to be more normal on average. So this means that when we have abnormal profitability, if a company is reinvesting the earnings, the reversion toward the mean is likely to be faster. But in general, we have this effect that if you're going to reinvest additional capital, the new capital that you will invest is not going to generate the same level of abnormal profitability. And since future profitability is basically a weighted average of profitability from existing capital and profitability from new capital, we'll get this ROE in the future moving toward the mean because it includes an increasingly larger portion of profitability which is due to new capital. So this is an important effect which, again, in my opinion, is not appreciated enough in the literature. People in finance and a little bit in accounting too talk about real options. So basically, if profitability is very low, you can discontinue operation or you can revise operations, and this will cause the profitability to go up. But in contrast, if profitability is high, you're in a good shape, you're not going to reduce profitability. So this effect is actually applies only from below the mean. If profitability is below the mean, it should go faster toward the mean, and we saw this indeed in the figure that I show you. And there is some research that appreciates this, including Pharma and French, for example, in a Journal of Business paper. And then we have these purely accounting effects, conservatism and big bet. So, for example, when we recognize impairment losses or other asset write-downs, and when we have big bet charges, restructuring, and so on. This, again, apply only to profitability, low levels of profitability. And there are several reasons why what we are going to have is an increase in profitability going forward. First, this type of charges are not likely to recur. So again, if you have these charges in current profitability, they're not going to be there next year, so ROE will go up. Secondly, we know that many times when companies take these type of charges, they do it in order to increase future earnings. So for example, if you recognize an impairment of fixed assets, in the future you will have lower depreciation, and so higher earnings. So we'll have this numerator effect on future earnings when companies take these type of charges. But there's also a denominator effect, because if you take a charge now, you reduce your equity, and the lower equity is used as a basis for calculating profitability in the future, which therefore means that if you take a charge today, profitability in the future is going to be higher. So these reasons again imply a mean reversion in ROE. Low ROE is going to be followed by higher ROE. Some of this is there is research documenting this. I don't think that there is much new information here, just the fact that when you look at the research, you usually don't see people using all these facts in the analysis. Okay, so if the current level of ROE tells us something about future earnings changes, future profitability, this suggests that if we analyze profitability, we may be able to get even more information about future profitability and future earnings. And you can think about, and the literature has done, analyses along two lines. One is to look at the time series behavior of profitability. Another is to decompose profitability. There's quite a lot of research here, but very little research here. Very little research here. In fact, when I looked at this, I found most of the research again in finance. Pharma and French, the Journal of Business paper is exactly about this. I did some work with Trevor, and there is some additional work, but generally very little here. The point here is as follows. We know that ROE is useful for predicting future earnings changes because it tends to revert. But it's not always the case that ROE reverts. We know pharmaceutical firms, for example, because they have conservative accounting, because we don't recognize R&D capital on the balance sheet, for them, ROE will stay relatively high forever. So if you look at the time series of ROE, you will be able to identify situations where the ROE is high on a consistent basis, or ROE is low on a consistent basis. So again, this is one place where a time series analysis of profitability can help in the forecasting of future profitability and future earnings. It can help you identify what the normal level of profitability is. It will also be useful to analyze the time series behavior of ROE to learn about how it behaves over time, the trend, linear, geometric, quadratic. We know that the trends are not likely to be linear, yet but when we see people using time series behavior of profitability and valuation, for example, they tend to assume linear trends, which, again, is not likely to be the case. Sometimes you see, because the behavior is not linear, the convergence is faster than what is assumed in a linear trend. Sometimes you see people use geometric conversion, which is probably problematic for the other reason, which is it assumes a convergence which is too fast. Quadratics seem to provide a better fit, but again, this is not a perfect trend yet, and more research should be done along these lines, in my opinion. Studying the time series behavior of profitability could also be useful in estimating the persistence of shocks to profitability. Again, very little research here. In my opinion, we can do much more here to learn about how to predict profitability and earnings. We have much more research in this type of analysis, and I'm going to review this research along these three lines, starting by decomposition of profitability into core profitability and one-time profitability, then operating profitability versus leverage effect, and analysis of operating profitability and leverage. So I should probably be much faster. ROE, core ROE versus one-time ROE. So you go to the income statement, you try to identify from the income statement one-time items, and by definition, this portion of the ROE should be less persistent than this portion. So this seems trivial. If you want to predict where ROE is going from here, you want to identify what portion of the current level of ROE is core versus one-time. The problem with this analysis is that there are several problems. First, it's not always easy to identify one-time items. And secondly, we know that many times companies report one-time items, unusual items, year after year, so it's not really unusual. There are also these two things, which is correlation. Core ROE and one-time ROE tend to be correlated because of earnings smoothing, for example. And one-time ROE today affects future core ROE. And these are two things that have to be considered. If you cannot just take these two components of ROE and just assume that one is more persistent than the other, and that's it. It's a little bit more complicated than this. There is correlation between the two components that matters, and there is the implication of a one-time ROE today for future profitability. And I talked about this one and this one, actually. I already mentioned them. In terms of the analysis of operating profitability, we can decompose the profitability of equity into the profitability of operating and investing activities and the leverage effect. So ROE is a measure of bottom line profitability from all activities, operating, investing, and financing. This one is a measure that reflects profitability from operating and investing activities. So the leverage effect basically identifies for us the effect of financing activities. And we have good reasons to expect an empirical research that demonstrates that our NOA, the profitability of operation, is more persistent than the leverage effect. We will see later on why, too. In terms of the analysis of our NOA, we can think of two types of analysis, decomposing our NOA into profit margin and asset turnover, which is, we have some research on this. We have less research on this point, which I will touch on, too. Profit margin versus the asset turnover. We have these two drivers of operating profitability, and we know that each of these two is affected by or reflect different aspects of operations. We know asset turnover tells us about asset utilization, outsourcing, some product market strategies, for example, cost leadership, and so on. Profit margin about cost control. And both of them are also affected by accounting distortions, but they are affected differently. Profit margin will be affected by past impairment or restructuring. Asset turnover will be affected by excess capitalization and so on. So we have good reasons to expect that these two drivers of profitability should behave differently, should have different persistence. But the research actually is surprisingly inconsistent on this. I looked at the literature and I couldn't find really good bottom line, good conclusions. We know, for example, that this guy is more volatile than revenue and net operating assets, so this should mean something about predicting about the persistence of these two value drivers. We know both of them tend to converge toward industry benchmark. Again, we have several additional insights, but these insights don't seem to translate into something that we can immediately take away and use for the prediction of earnings. We can do further analysis of profit margin. We can do a time series analysis to identify trend or to learn about the persistence of changes. We can do common size income statement because we know the different line items in the income statement have different level of persistence. And now recently we have some research that suggests that some line items have this feature of stickiness, means asymmetric response to changes in sales. So for example, SG&A goes up when sales increase, but it doesn't go down to the same extent when sales decrease. Again, you don't see academic research that predicts earnings incorporate this property. And also not that much incorporation of the property of different persistence for line item. Operating leverage analysis, fixed cost versus variable cost. Again, the insight here is very clear, but again, not much research used this insight. Part of the reason probably is because we don't have that, the disclosures in the US don't really allow you to come up with good estimates of fixed versus variable cost. But maybe we should have better disclosures that will help us here. We know in Europe we have more disclosures about labor cost, raw material, and so on. So this is maybe something that should change at some point in the future. Asset turnover. We know trends in asset turnovers are informative about accounting distortions such as excess capitalization. Again, persistence of changes. And we have good reasons to expect that different assets will have different persistence for their turnover ratios. This analysis, looking at the profitability of operating assets versus the effect on profitability of having operating liabilities. So operating liabilities are all liabilities other than debt. And we cannot observe a return on operating assets, but we can estimate it. In order to estimate this, we need to come up with an estimate for the cost of operating liabilities, which is implicit in operating expenses. But given estimates, and we can come up with estimates, we can try to identify what portion of the profitability of operation is due to the profitability of assets versus the contribution of having some of the operations, basically some of the operating assets funded with operating liabilities. We have some research on this showing that these two components of our NOA have different persistence. This is actually also relevant because sometimes we have companies with negative operating assets. So if you still want to do the analysis in a way which is consistent with all the development that we did in the literature, and net operating asset is negative, then what you can do is you can use return on operating asset as a substitute. Why is this effect important? We can decompose the operating liability leverage effect into the amount of operating liabilities leverage and the spread. And doing this is relevant because we know this one tends to be more persistent than this. And we also know that this guy has implications for future profitability independent of this term. And the story here is these two arguments are very much related to the accrual anomaly, just that we are focusing here on the balance sheet amounts instead of the income statement accruals. So basically, the more estimated liabilities you have, it means that you understated your earnings today, and so your earnings in the future are going to be higher. And similar argument applies to the denominator of the operating liability leverage. If you overstate your operating assets, this will be lower, and in the future you will have lower operating income. So these two imply accounting effect very much along the lines of the accrual story. This one is the fact, and on this there is actually some research in finance showing that companies that have more operating liabilities compared to debt, there is information in this. It tells you something about the profitability and the prospect of the company because suppliers know about companies more than other lenders, and also because many times when you have these liabilities, it indicates that the company has market power. Dell, for example, is an extreme example of taking advantage of this. A similar analysis for the leverage effect. The amount of leverage, the spread, we're all familiar with this. But again, the two components, if you do this decomposition, you should learn something about the persistence of profitability, where we are going from here. There is another decomposition that we can do, which is not done in the literature, but I like this because it basically allows you to distinguish between the benefit from leverage and the cost of leverage. The benefit from leverage is that you have more net operating asset than equity because you have net debt. So you have a larger investment base in operation compared to the equity investment. So this is the benefit from leverage. But because you borrow, you don't get all of the NOPAT. You only get net income, which is less than NOPAT. So benefit from leverage, cost of leverage. I didn't see any empirical research that tried to decompose or to try to look at the implication of this decomposition. It seems that there should be some implications. I'm now going to move on to earnings quality and talk about results from this research which are relevant for the prediction of earnings. Unlike many people, I still like this one a lot. I think that the quality, my research tells me that, this is very much still there. And you can talk about cash flow to price, and we have some published research on this. I was not able to replicate this result. I always find that the accruals to assets still provides incremental information even after you control for cash flow to price. The two measures share some common information, but they also each have incremental information. Now, we know that this anomaly or this the ability of accruals to predict future earnings, we know we can refine this by measuring accruals from the cash flow statement versus balance sheet, by trying to estimate discretionary accruals, or by focusing on those accruals that are more likely to reverse and are more likely to reflect bias. The one feature, I think that I think can actually bring together these two is by, instead of deflating accruals by total assets, deflating accruals by net income. Because what you have then basically is accruals compared to net income, and you're capturing both the relative magnitude of accruals and the relative magnitude of cash flow. And again, this shows that especially for those companies with a high level of accruals, where we're going from here is lower earnings in the future. We see this trend down. This is basically future earnings divided by current earnings. We see this drop in earnings that we see for all firms is due to the fact that in the year of the portfolio construction, we restrict the sample to include only those companies with positive earnings, but we don't do so going forward. And we do see the ability of accruals to net income to identify low persistence cases. Another earnings quality analysis that has implications for future earnings is comparing taxable income versus book income. A measure we can estimate taxable income using the disclosures in the financial statements and compare this to net income. And this will tell us something about where earnings are going from here. Actually, it tells us quite a lot. And there are several reasons for this. One reason is the taxable income, even though it's also subject to manipulation, it's subject to a different type of manipulation. So if you compare taxable income with income, you basically come up with a proxy for how reported earnings in the denominator have been overstated or understated. We know also that taxable income is likely to exclude some transitory items, which reverse. And we know that sometimes companies smooth taxable income, and there is research in finance that talks about this. So this tells us basically that taxable income today is informative about taxable income in the future, and therefore about future earnings. And the result here is very strong. So this is basically portfolios constructed based on the ratio of taxable income to earnings. And we see that those companies that have a high ratio, earnings are going up. Companies that have low ratios, earnings are going down by a lot. And then we have all these fundamental signals from the literature. I'm going to review some of them. Abnormal increases in receivables, we know it's an indication or could be an indication of overstatement of revenue, stuffing the channel, for example. It could also indicate that we had a negative demand shock and we tried to extend additional credit. The company tried to extend additional credit. And it could also indicate that receivables are relatively old, which means that we are more likely to have write-offs of receivable going forward. Inventories, we have many stories. Jack did some research on this. We know that when we have increases in inventory, it could be an indication of a negative demand shock. We were not able to sell what we wanted to sell. So this means that we are likely to reduce prices in the future, and that we're going to have write-downs of inventory going forward. We also know that high level of inventories mean that we spread fixed cost over a larger number of units, therefore reporting lower cost of goods sold, higher income, and this is not going to continue in the future. And also the possibility of excess capitalization that we included in inventory costs that shouldn't really be in inventory. With CapEx, initially people looked at the CapEx as potentially good news. For example, if you look at the Levin Tagarajan paper, when they talk about this signal, they're saying more CapEx could be an indication of good news. But in the 15 years or so since they did the research, we now actually expect exactly the opposite, because we view CapEx as a possibility of indication of overinvestment by the company, the possibility of excess capitalization, treating period cost as capital expenditures. And when you compare CapEx to depreciation, it can also tell you something about depreciation, whether depreciation is not sufficient, because obviously depreciation is subject to a lot of discretion. Changes in R&D and advertising. So basically, conservative accounting, we treat these expenditures as expense, while really it's an investment in the future. So when companies cut these expenditures, they are increasing current earnings and reducing future earnings, because if you do less R&D now, you will have lower earnings in the future. And both effects imply that this signal should predict future earnings changes. And again, there is research demonstrating this. Gross margin. This has to do with the persistence of a line item in the income statement. We know that generally the top lines are more persistent than the bottom line. And so gross margin, which reflects sales and cost of goods sold, is likely to be more persistent than other items in the income statement. Therefore, changes in the gross margin have implications. If you consider this signal, it has implications for predicting future earnings. Effective tax rate. We know changes in the effective tax rate are relatively transitory, so we can use this again as a signal of where earnings are going from here. The bad debt expense, highly discretionary expense. So again, companies can increase reported earnings now by cutting the expense, but this means that in the future earnings will be lower when they actually have the receivable write-downs or write-offs. LIFO reserve. Changes in the LIFO reserves are recognized as part of cost of goods sold, so they affect reported income. But they have nothing to do with economics. They have nothing to do with performance. They just have to do with the timing of inventory acquisitions. So if you look at a change in the LIFO reserve, indication for where earnings are going from here. And Steve and Shajun have research on this. Unusual items. We basically touched on all these points. Two additional points. Actually, additional point is that we know that this item is highly mean reverting. So again, we can use this point. And the fact, and we talked about this one, so I will just move on. Another source of information about earnings quality, which could be informative for where earnings are going from here, is looking actually at those assumptions that companies have to disclose. And this is primarily in the pension and other post-employment benefits, but now will be somewhat relevant also with respect to the ESO expense, employee stock options. We can look at these assumptions and examine them, whether they make sense or not, whether they are understated or overstated. And from this you can figure out what will happen in the future in terms when companies have to adjust their assumptions or when they actually have the cash flows. Growth analysis. So we can look at past growth rate in earnings, revenues, assets, equities, and so on, and assume that what we had in the past is going to happen in the future. The problem is that usually it's not a very good indication, and we have some recent research in finance that demonstrate this. Past growth rate, a very low level of persistence. We also have some research in accounting that shows this. Now, we think if we want to predict earnings, we want to look at past growth rate in earnings. But the problem with growth rate in earnings is they are very volatile. So you don't learn much from past growth rate in earnings. And this is why people usually use past growth in revenues in order to predict future growth in earnings. This is exposed past information. You can look at ex-ante information. How much investment is taking place now, because more investment now implies more earnings in the future. The problem with these investment intensity ratios is that they are affected by those accounting distortions that we talked about earlier on. Overcapitalization, accounting treatment, the expensing of R&D, and so on. This variable is looked at a lot in the finance literature, but not in accounting for some reason. And basically, this is the sustainable growth ratio. And this one is essentially 1 minus the dividend payout. What portion of the earnings are reinvested in the company times what is the profitability that these earnings generate. I think that this will make sense to examine this one using what we know from accounting about these two ratios and try to incorporate them in the analysis. For some reason, you don't see people in accounting using this. Growth and profitability. This is much research on this recently. We know that when we have a growth in net assets, this is usually predicts a decline in profitability, and there are several stories here. One story is that new investment, which we touched on last time, new investments are likely to be less profitable than existing investment. And this is basically due to the fact that when companies select investment, they first go with the most profitable one, and then select the less profitable project. So new investment will tend to have lower profitability. So if you have an increase in net operating asset, it predicts a reduction in profitability. Conservative accounting and the realization principle, and Steve likes to touch on this one, not Steve Payman. So basically, the point that we don't recognize the profit that we'll get from investments that we take today, and we expense them now, the investments. So we have this basically violation of matching because of conservatism in accounting and because of the realization principle. And there's the research that shows that growth in net assets is to a large extent, it basically reflects the accrual anomaly. So for these reasons, we expect, and this actually, empirically, this works amazingly well. The growth in net assets is a very strong predictor for changes in profitability. We also have research, not from accounting, some of it was done in accounting actually, that shows that there are many additional variables that we can consider. Much research falls here, actually, if I start here. Corporate finance events, dividend changes and the implications for future earnings, equity and debt offering and the implications for future earnings. When companies engage in new investment projects, the implication for future earnings. So again, quite a lot of research in finance on this, which in accounting we don't seem to incorporate when we come up with predictions for future earnings, or not to the full extent. Quite a lot of research on indicators of demand. Product market size, market share, customer satisfaction data, volume, order backlogs, and also some indicators of capital, including human capital and the productivity of capital. Macroeconomic predictors. So far we discussed the firm-specific predictors of earnings, but we know that earnings for companies, the aggregate earnings, we can predict them using information from macroeconomic variables, and if we know where the overall economy is going, it tells us quite a lot about where individual companies are going. We know that changes in interest rates reflect either changes in expected inflation or changes in real interest rates. And we know for expected inflation, we have some research about the implications of changes in expected inflation for profitability. We know, for example, that revenue adjusts immediately for inflation, but some expenses adjust with a delay. So this means that an increase in expected inflation, earnings should go up, not just nominal earnings, but actually real earnings in the short term, because in the short term, it's mostly the revenues that will reflect the inflation, not the expense. Depreciation does not adjust immediately. Cost of goods sold, when you use FIFO, does not adjust immediately, and so on. Obviously, an increase in expected inflation means higher nominal earnings. And also there is some research from about 20 years ago or so making the point that for tax purposes, we don't adjust numbers. So if you have an increase in inflation, companies, the value of the depreciation deduction is going to go down. So there are tax implications of expected inflation. So there is some research talking about expected inflation and future earnings. With real interest rates also, you can talk about hurdle rates that companies use in making investment decisions. A higher real interest rate implies that now you have to invest in more profitable projects. So implications there, and lower investment. And you can think about this as reflecting shocks to the economy. Again, so changes in interest rates should tell you something about shocks to the economy, and by inference, tell you something about earnings. This applies to realized inflation, the same effects. And you can think about measures of economic activity. Here the relationship is clear. Some research on price-based forecast. Price is basically a reflection of what the market thinks earnings are going to be in the future. So if you compare price with current earnings, you're basically getting a measure of what investors think earnings are going from here. So price-earnings ratios is an indicator of subsequent earnings changes, and we have quite a lot of research demonstrating that there is definitely information in prices about future earnings changes. The research on stock returns, the results here are weaker. So even though the same logic applies, that if we have a shock to price, it means a shock to expected earnings, research generally does not find strong results for stock returns predicting future earnings changes. The market-to-book ratio, basically a measure of future profitability and growth. So we can extract information from these two.